Hello, everyone. My name is Lauren Antone, and I'm the Senior Marketing and Events Coordinator at MAR, as well as the producer of our free webinar series. Our webinar today is 1031 exchanges. This webinar will help you to understand how to defer paying capital gains taxes when you sell an investment property and reinvest the proceeds in a property of like kind. We will talk about rules, concepts, and definitions you should know if you're thinking of getting started with a Section 1031 transaction. After our live session, the webinar will be recorded and added to our website at marealtor.com. If you have any questions throughout the session, please type them in your chat box on your screen, and we will hold a Q&A afterward. Our presenter today is Lynne Bagby. Lynne is the New England Division Manager with Asset Preservation, Inc. She has earned the Certified Exchange Specialist designation from the Federation of Exchange Accommodators. Working throughout the Northeast since 2000, Lynne has facilitated thousands of various types of exchanges and is committed to quality customer care, as well as providing the most current information available with regard to IRC 1031 and the client exchange process. Asset Preservation, a subsidiary of Stewart Title Company, is a leading national IRC 1031 qualified intermediary and is efficiently handling exchanges in every state. Combining a national title company as a partner has proven to be the approach of choice by astute investors. Asset Preservation is one of the most respected national qualified intermediaries in the United States and has successfully completed over 180,000 1031 exchanges throughout the nation. Lynne has been educating and servicing investors, attorneys, real estate brokers and agents, accountants, financial advisors, and mortgage bankers or brokers for the past 20 years. She has taught continuing education in all 6 New England states, appeared as part of the local and national education exchange panels, and has been a guest on real estate-related radio programs geared to real estate investors. Her exchange presentations are practical and feature many real-life exchange scenarios to illustrate a wide range of investment and tax strategies. Now, over to Lynne.
Good morning, everyone. Thank you so much for joining in today. I've really been excited about this presentation. The group over at the Mass Association of Realtors was kind enough to have me in. I guess, Lauren, it was about a year or so ago to do a recorded webinar, and was invited back again, and I've totally been looking forward to it since I do live here in Mass and work with many, many agents and brokers throughout the state. So without ado, my class is usually always titled The Power of Exchange. As we go through the program this morning, you're going to see how this tax code is extremely beneficial for real estate investors, from the individual investor to large corporations and businesses, to maintain and build wealth through real estate investing. So we'll just, without further ado, we'll get started. Here's Lauren just went through all the stuff about me, so we're going to forward that to save some time. And let's just talk right off the bat about what the definition of this tax code actually is, so that there's no questions. So basically, IRC Section 1031 reads like this: no gain or loss shall be recognized on the exchange of real property, which has been used for productive use in a trade or business, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. So that is the definition. It is real estate, investment real estate, that is the only asset class that is able to use Section 1031. And so when they talk about real property, it's real estate used for productive use in a trade or business or for investment. So what does that mean? Rental income, whether it's residential or commercial, running your own business out of it, and or holding for investments, similarly to like holding a big tract of dirt, a chunk of dirt. So if you hold it for a long time, it usually appreciates in value. That can be part of the held for investment. So it'll kind of give you an idea. You can exchange anywhere within that asset class, and we're going to talk about different types of like kind property in a little bit. And again, there's a lot of different types of property in that. So I think you're going to find this really interesting when we get to that section. Okay, so When you are working with people that are selling investment property, and one of the things that you're going to want to do when you're going out for a listing, like how do you know? Well, you know when you walk into a property to talk to a potential client about listing their property, you're going to find out, is this property that you live in fully? Like, do you live here? The answer is yes or no. If it's a multifamily property, you're going to say, do you live in any one of the units of this building, or is it a full rental? Because we've got 2 tax codes to work with. So we're going to talk about the combination of them later down the road, but you're looking to see, is this property one that you live in part of and rent out part? Is it a full rental? So you're going to be thinking about those types of things. So if someone says to you, yes, I've been renting this property out now for a number of years, you know that that person's an investor and they may want to increase their rate of return upon the sale by using these methods. So investors may want to get out of the property that they're in. We're still in a highly appreciated market. They may want to leverage their money and buy multiple properties as replacements. So maybe they want to take some of all their cash and gain and reinvest it across several properties. Diversify. Maybe they don't want that multifamily anymore. Maybe they want to get a larger apartment building, or maybe they want to buy into office, or maybe they want to buy into a strip, or they may want to like invest across several different asset classes. Maybe they want to consolidate. For example, I'm meeting with people, a broker tomorrow that has a client that has 33 properties in their portfolio. They've been rental, and now they want to consolidate that sale. They want to sell that portfolio of properties, and they're going to purchase a larger building. So maybe they want to get out of managing several into something larger. Cash flow. Many times you're going to run into a client who's selling a property. They've owned it for a really long time, maybe 10, 15 years. Their tenants have been great tenants. They've been paying their rent on time, but they haven't been able to get that rent increase, because if you've ever owned property before, how do you raise rents on people to get them up to market value when you've had a good tenant for the past 15 years? Based on their incomes or where they are in the life cycle, maybe you haven't wanted to raise the rent on them. So for a lot of different reasons, people may want to get out of that property to go somewhere else that they can buy at a lower value, do a little fix-up work on it, and raise the rents to get that better cash flow. Management relief. Sometimes people have, again, had multiple properties or they've been managing property their entire life. They don't want to manage it anymore, and so maybe they're looking for some type of real estate that provides a passive income stream or that comes with property management in place. When you buy, you're going to hear me say to you, for a full deferral, you need to purchase new investment property at an equal or greater in value than you sold. Just take that as a blanket statement. I'm going to explain it a little bit more detail later. But what happens when you buy a more expensive property, you get an increase in depreciation, which is a tax benefit to you during the time you own the property. It's like a tax credit. And then estate planning. The one thing about that people want to change their holdings around, maybe they're going to change the way they hold title and report taxes on the property, is for estate planning purposes, to be able to leave to their heirs. So those are the different things that you may be thinking about talking to your client about when they're looking to find other suitable replacement property to purchase in a 1031 exchange, is what is it that they're trying to do. As the qualified intermediary, whose role I'm going to go into in a little bit, but one of the things that I do when I'm speaking to clients is, what's your end game? What are you looking to do after you sell this property? You've got a big chunk of money from your sale. What is it that you want to go, what do you want your life to look like? So I'm talking to them about these things as well, but it's important that you have a conversation up front. They usually have an idea, but so that you can be looking for the appropriate property for them in their real estate investing strategy. So when you sell a property, so many times I'll get a call from either agents, brokers, taxpayers, and they'll think, oh, well, don't I just have to pay 15% on my sale? No, not so fast. This is capital gains taxation. It's different. There are 4 components. You've got the depreciation recapture tax at 25%. Then you have the federal capital gain at either 15 or 20 based on income. The thresholds are here. You've got the net investment income tax, which is part of the Affordable Care Act, on the investment on that sale at 3.8. Then you've got the applicable state tax rate. Here in Massachusetts, it's somewhere between 5.1 and 5.2. I usually averaged about 5.2 on the gains. So when you cobble them all together, you will find that someone in the 15% tax bracket for federal capital gain and who needs to pay the net investment income tax may be somewhere between 28 to 29% on their gain, whereas that same person in the 20% is up to about 31 point something. So without that net investment income tax, I usually tell people in the 15 that their taxable gain is going to be somewhere between 25 and 28 point something when cobbled all together, especially if they've owned the property for a while. If they're in that 20%, it's going to be somewhere between 28 and 31 point something. Okay, so that'll give you a general idea. So here's what doesn't qualify. We talked about what qualified generally. Real estate that you've used for productive use in trade or business or held for investment. So what doesn't qualify? Stock and trade or other property held primarily for sale. Underline that one, because that's what you're going to run up against. And so I'll give you an idea who. Developers that plan on developing a piece of land, building a building, or rehabbing an older building and turning it into something else and then selling the property off. Or a flipper, property flipper, or a home builder. So those properties are being either built from scratch or rehabbed and resold. Okay, so that doesn't qualify. Stock, bonds, and notes. You might want to make a note here. This is where a real estate investment trust does not work because it is a stock. You're a shareholder in a group that holds real estate for investments that you're going to get a dividend check for. So that doesn't qualify. Other securities or evidences of indebtedness or interest. Basically, what you cannot do is sell your investment property and go pay off a mortgage note on something else, because what are you doing? You're paying off a financial tool. 1031, you sell a property, you purchase a property, or you actually swap properties. That's how the exchange process works. Interest in a partnership. So put a little note here because we're going to talk about exchange entities and a business entity ownership briefly in a little bit. So when someone holds a property in a partnership, there are partners inside that partnership, and the partnership or the LLC taxed as a partnership, the business entity owns the property, not the members. So an individual taxpayer cannot sell their investment real estate and buy into a partnership or an LLC taxed as a partnership that owns the real estate, because you can't exchange your taxable ownership of real estate into a membership interest in a business entity or a partnership. Okay. However, you'll see that an LLC taxed as a partnership or a partnership itself can sell a property and do a 1031 exchange, and that same business entity buys the replacement property. You just can't, as an individual taxpayer, buy into one. Okay, certificates of trust or beneficial interest. Sometimes we have regarded trust for tax purposes, meaning the trust is the taxable owner of the property as well. You cannot buy a beneficial owner, you cannot sell a property individually and buy a beneficial ownership position in a trust. End of the day, for these two, you need to be having a deeded percentage of ownership in the property where the tax reporting number you have is the actual tax owner of that property. And then it shows an action. If you win an award to a lawsuit, those dollars are taxable and do not qualify under Section 1031. Okay, so that brings us to the exchange entities. One of the things as a qualified intermediary when I'm working with your clients is they'll tell me, I usually ask them who's on the deed, and I'll say, whatever entity or person on the deed, are they the actual tax owner of the property? How does the IRS know you? Because this is, when you're doing a 1031 exchange, you are taking a tax election on a real estate transaction. Another key phrase I want you to remember, the 1031 portion of this, of the transaction itself is a tax election on the real estate transaction. So all the moving parts of the real estate transaction are still going to be per usual. The 1031 is the tax election. So I am looking for the tax owner of the property because that's who the exchanger really is. So let me give you some examples. So I have a situation where I've got a legally married spouse. In this case, it's a wife. She is selling the property because she bought it before she got married, say, and now she's going to be the person that acquires the replacement property. Make a side note here because to talk about community and non-community property states. Massachusetts is a non-community property state. 41 of our states are non-community properties. So even if you are a legally married spouse, you are still viewed as an individual tax owner. So in an example where this applies, I've got a wife who purchased a property when she was single, she got married, never changed the deed. Let's just say she's selling this property, I'm making numbers easy, for $500,000. If she's only going to buy it's $500,000, she is the person who goes on the deed for the purchase of the replacement property. However, she has a legal spouse who wants 50% ownership. Well, she needs to buy for $1 million for that spouse to be able to go on the deed as a 50% owner because we're non-community property. There are 9 community property states where legally married spouses on the same deed can, they've got some other benefits. We're not going to go into them now, but none of them are around here. So I doubt you're going to need to deal with them. So for the purposes of 1031 exchange, if one of the spouses has been on a deed prior to the marriage, or even if they're married, they're the only one on the deed now. If the property that's going to be purchased is of equal or lesser value, they're the only spouse that can be on the deed for the purchase. Doesn't mean it can't be changed later down the road with advice from a CPA, but for the purpose of this conversation, we're going to stop with this. Smith LLC sells, Smith LLC acquires. It's because of tax ownership, must remain constant. So the LLC is either being taxed as a corporation or as a partnership. It needs to stay constant so that the tax reporting stays the same and the tax ID number used. Gemco Corp sells, Gemco Corp acquires, same thing, same tax ID number. The Durst partnership sells, the Durst partnership sells, same tax ID number, must stay constant. So here's a few things you need to know. It's necessary to distinguish between federal tax ownership, state law ownership, and vesting. So one of the things I'm gonna jump down to is that state law ownership, which is where the non-community and community property for legally married spouses come in. So let me give you an example. I've got 2 legally married spouses on a deed to a property in their individual names. They've been reporting under their social security number, filing on a 1040 and a Schedule E. Now they're selling this cute little single family rental they have, but now they want to buy a student, well, not in COVID year, next year in 2021, okay? Because we don't know if the college kids are going back to school. So now they want to buy a property out at UMass Amherst. It's in college, and college kids are maybe it's their first time away from home, and I don't want to stereotype them, but maybe they want to have some liability protection. In non-community property states, what legally married spouses who have been reporting individually on a 1040 and a Schedule E cannot do is form an LLC because they're not viewed as one unit. They're viewed as 2 separate taxpayers. It makes it a multi-member LLC, therefore and they're going to most likely take the partnership tax election. It's not a like-kind tax owner. It's not the same. The tax ownership's going to change. So the reason I'm going into a little bit more detail is so that if you're doing this yourself, you've got a family member or a close friend, all I want you to remember, if someone's saying, well, we own this property, but we want to put it in an LLC, you better call your qualified intermediary right away because I took a class and there's issues about that. Nip it in the bud. So let me just give you an alternative viewpoint. So California is a community property state. If I've got 2 legally married spouses on a deed, they've been married filing a joint tax return, they both appear on the deed, they can form a single member LLC because they're viewed as one unit in a community property state. So that's the contrast, and my purpose for letting you know this. Key buzzword, we're thinking about putting this into an LLC, and you've got 2 legally married spouses. Call the qualified intermediary. Now, a taxpayer who elects taxation as a sole proprietorship which is disregarded entity for tax purposes, can sell a relinquished property as an individual and acquire the replacement property as a single member LLC. What does that mean? So if someone has a sole proprietorship or they're an individual tax owner on the deed, they're the only person, and now they want to form a single member LLC, they can do that if they take the individual tax election, because why? They're not going to use the federal TIN number assigned. They're going to use their social security number, their 1040 form, and their Schedule E, just like before when they were individual tax owner. They're buying in that single member LLC with the individual election. It becomes disregarded for tax purposes. And at the end of the day, the IRS sees that individual and he or she's using individual tax reporting. Okay, so there you go. That's enough about that one. Anything else, give me a call. My contact information is going to be on the back end. Glad to have side conversations with you about this. Then sometimes you'll have an LLC that has 2 members, and here's what I'll see. When people call me as a qualified intermediary with an LLC, I say how many members. If they tell me there's 2, well, first of all, I find out, is it single member or is it multi? Well, there's 2. What I ask then is, what is the percentage of ownership of each of these 2 members? Because if I see one that has 1 member with 98% or 99%, then I go to this. What is the purpose of that person with the 1 or 2% ownership? Is to keep them out of bankruptcy, and do they have any financial interest at all in the profits and losses or managing rights? I'm looking for a no answer on that one, because then that one would be a single member LLC also. So anyway, those are questions for the QI, but I want you to, the whole purpose of this was when you see business entities, people are talking about changing them, you want to get on the phone with the QI right away. It's not your job to be talking to them about this stuff. It's not mine either, really. I ask them all these investigative questions, and then I help them pose questions if I see a red flag for them to go talk to their CPA about, and we kind of have sort of a conversation about it so that they can proceed to make sure that their exchange does not get disqualified, because tax ownership must stay constant. Okay, now, Section 1031 normally allows you to sell to whoever you want and buy from whoever you want, or swap properties from whoever you want, except you're going to find they don't love your family as much as you. So they do like them a little bit, however. So it's important to note related parties. So here's why I say this. Many times I will have a child or offspring of the parents, and the person wants to sell the property and buy something that their parents own. Or I'll see someone that owns property in a business entity and they want to buy property from another business entity for which they or their relatives have an interest in. So the IRS will allow you to do business with your related parties, but they have some restrictions. So first of all, who's a related party? Section 267B of the tax code has a laundry list of items and of situations. I'm going to only deal with the first 2. So who's a related party? The seller's immediate family, brothers or sisters, either by whole or half blood, their parents, grandparents, and lineal descendants are all related. In-law and spouses are considered related, but in-laws are not considered related parties. Aunts, uncles, cousins, or ex-spouses are not related. Or an entity ownership where you or the business entity who's the tax owner either directly or indirectly owns more than 50% of a property, all related parties. So in situations where there's rules on related parties, if Lauren, I'm going to pick on you, Lauren, if you were my sister and we decided we wanted to swap investment properties, which happens sometimes, especially with relative in the area of vacation rentals, I see it happen a lot, or frequently, I should say. If Lauren and I wanted to swap our investment properties, she must hold on to my property for 2 years before she does anything with it. She's got to hold it out for rental income or whatever the business purpose, okay? So she's got to hold on to my property for 2 years. I have to hold on to hers for 2 years and do the same thing, some type of rental income or business purpose. And we are not able to sell it, exchange again, or move into it for a 2-year period, okay? Now, if, again, assuming Lauren is my sister and I want to sell my property to her, that's fine. Fair market sale, I can sell it to her and she can do whatever she wants with it. Nobody cares. However, if I sell my property to someone else as an exchanger and I want to buy from Lauren, who's my sister, according to revenue ruling, which is an IRS safe harbor 2002-83, so it came out in 2002, based on this private letter ruling here. If I went to buy my sister Lauren's property as replacement property in an exchange, she must be able to do a successful 1031 exchange also, which means the property that I'm buying from her must have been investment real estate. So that's the rules on relatives.
Quick question on that, Lynn.
Yes, Lauren.
We had somebody ask about adopted siblings.
You know what? I'm going to send them to their CPA. I did have a situation where a CPA said it was okay. There was no blood relation at all, but it is legal. It's a legal adoption. So I would send them to their CPA just to be sure that their CPA feels the same way. So it's not specifically written in the tax code. I'm not the authority. So we want to talk to their CPA about that and see what their stance is.
Okay, thank you.
Okay, sure. All righty, because what one CPA says might be something different for another one. So like-kind property, here's some pictures taken on lovely days for the most part. So it's any kind of investment real estate for any kind of investment real estate. So let me give you some written descriptions. First of all, what doesn't qualify? Your primary residence does not qualify. So if you want to sell your house, you're going to have the Section 121 exemption for that, which is the primary residence exemption, the exclusion. Property held for sale and dealer property, we addressed in an earlier slide. What qualifies? Already did the definition. Property held for productive use in a trade or business. You are going to purchase property that you intend to do the same thing with. You can exchange a rental property that you had. Let's just say, for example, someone was selling, they were selling a multifamily property, but now they're going to buy a little single family and they're going to run their own insurance agency out of it. Yes, they can do that. I'm going to tell them to talk to their CPA to be sure they're setting up their business properly for their insurance agency, and they're going to handle all the paperwork so that it's a clear intent that it's not a hobby. Okay, so not that insurance agent, being an insurance agent would be, but you just want to be sure that the business intent is there because you're going from rental income to running your own business, and that's perfectly fine. And so is the type of property, provided you meet the definition of the tax code. Now, real property is a very broad asset class. So other than the usual properties you're usually looking at every day that can be held out, single families, multifamilies, chunks of dirt, things like that. Other properties that work are air rights, perpetual communications easements like cell towers, some agricultural easements, oil, mineral, and gas rights, leasehold interests of 30 years or more, fractional ownership interests such as Delaware statutory trust properties, which are those passive income properties I mentioned briefly earlier, and qualifying vacation home rentals, so which allows you for a little personal use time. All those types of property can qualify. So that brings me to vacation homes. When I'm talking to residential agents, and even commercial brokers sometimes, because sometimes people are looking to do a little something personal too, vacation homes are huge, okay? Huge, 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 because many people want to have something that they can have a little personal use time into. Prior to 2008, which is the year the revenue procedure came out, there were no real clear guidelines on what a qualifying vacation home looks like, but here they are, folks. Let me also interrupt by saying, for all the slides you see, they have a title at the top. If you ever want more like printed material on a specific subject, just email me. My contact information is in the back, and just say, Lynn, I'd like your printout on vacation homes. I'd like your printout on business entities. I'd like your printout on the stages in a 1031 exchange. I'd like your printout on whatever the topics are that you see here, because we've got over 150 printed pieces of material on various topics about 1031 exchange. So that said, vacation homes is one. What is a qualifying vacation property? It doesn't necessarily mean a property in a vacation area, and I will tell you that a second home most likely will be taxed, so you want to clean up your vocabulary a little bit as well and talk about vacation home properties as it pertains to Section 1031 exchanges are qualifying vacation home properties. They look like this. For a relinquished property in a vacation area that qualifies prior to a sale, or for a replacement property purchase that the exchanger wants to qualify as replacement property in a 1031 exchange, it needs to look like this. You must have owned the property for 24 months, according to these following rules, or you're going to buy it for the next 24 months and hold it like this. Within each of the two 12-month periods that comprise the 24 months of qualifying use, the taxpayer must have the property available for rent and then rent the property to another person or persons, including your family, they like them a little, but not a lot, at fair market rent for 14 or more days, does not have to be consecutive, okay? And report the income and all that on your tax returns. Then, again, still available for rent when it's not rented, the taxpayer gets to personally use the property unit for 14 days, does not have to be consecutive, for each of the two 12-month periods, or 10% of the time that it's rented. So let me spell that out for you. An exchanger purchases a property on August 1st, okay? For the next 24 months, it's available for rent, but they're able to also, and it's rented according to what I just said. However, they want to use the property a little bit. They can use it, let's just say first 12-month period, they rent it for 90 days. They automatically get 14. Let's just say second 12-month period, they rent it for 160 days. They're going to get 16. Okay, so you automatically get the 14. Once you get over that 140-day threshold, like into to 150 days, 160 days, you're going to get the greater 10% of the time that it's rented. So the key question I next get from people that I'm not going to wait for the checkbox is, what about when it's not rented? It's just not rented. Doesn't allow you to go use it more. I will make a side note here. If the taxpayer is handy and they are the ones making, doing construction projects, making improvements to the property, doing the maintenance and repairs, go talk to your CPA about quantifying that. It doesn't mean you're going to have to go get a hotel or drive back and forth to work on the property, but it does not have to go into your vacation time, but work it out with the CPA as far as quantifying and qualifying that time that you're working on the property. Let's put it this way, you're not going to get an extra week down there for painting the bathroom. So, and then after the 24-month mark, if someone wants to convert the use of the property to a second home or move into it with advice from the CPA, there should be a way you can do that. But then you've got to, if you're going to sell it at a later date or you're thinking about selling it, you only got two special ways to get special tax treatment on the sale of real estate. One is the 121 primary residence exclusion. The other is Section 1031 as investment property. So if you've taken it off the market to use it as something else, prior to selling it, it needs to fit into one of those two categories again. So we're going to leave that there. I would suggest a taxpayer speak to their CPA before either just converting it from a rental or just converting it from something that you've used personally, if you want to be able to get some special tax treatment in either the form of 121 or 1031. I do have some printed materials on that too. Okay, so I'm not going to go through this tax chart. If you ever take a continuing ed class, we're going to go through it in more detail, but 3 numbers you need to know. The first one is, what is your net adjusted basis property? Make a side note here that the net adjusted basis is the tax platform from which capital gain is calculated. It's your tax platform for what capital gain is calculated. If you buy at or below that net adjusted basis, you have no tax deferral. So anything you buy that's enough greater than that, up to a full deferral where you're buying equal or greater in value than you sell, will allow you to defer the capital gain and the taxes due on it in the form of either a partial or a full exchange. So let's just say that someone's selling their property for $1.2 million. If you want to determine what their capital gain is, you'll take out that net adjusted basis again, which is the tax platform from which capital gains are calculated, minus the cost of sale. So what are those costs of sale? Real estate commission, tax stamps and recording fee, your attorney's fee for legal counsel, and the qualified intermediary fee. Those are the printed allowable costs of sale. Tax credits to buyers. paying assessments off at closing, leftover water bills. I've got a slide on closing costs, allowable and non-allowable, but those things are not considered allowable costs of sale. Can you pay them? Yes, off the settlement statement, yes, you can, but the value is liable for taxation. So the only ones are the ones that I mentioned. But that gives you a capital gain of $720,000. That's what gets taxed. When you go through this entire system, you'll see in this formula, this exchange problem, that the total tax due would be $216,300. Question for every taxpayer is, do I want to write this check out to the feds in the state, or do I want to stay invested in real estate? My challenge is, where are you going to earn all that money? Where are you going to go out and earn that? So staying invested in real estate, whether for a partial exchange where you defer some tax and pay some tax, is a key question. How much do you want to reinvest? Either for a full deferral, you're buying at an equal or greater value than what you sold. So let's look at this problem again. So in this example, you sell for 1.2 minus the allowable costs of sale, which is $80,000. For a full deferral, this client would have to exchange and buy other investment properties at $1,120,000 to defer all their capital gains taxes. Anything less than that, but above the 400, enough above the 400,000 would allow for a partial deferral where they would pay some tax, defer some tax, and pay some tax. So again, what closing costs are allowable? On the sale, real estate commission, tax stamps and recording fee, their attorney's fee and the qualified intermediary fee. On the purchase, owner's title insurance policy and the settlement charges, okay? And if there's a buyer's broker fee. So those, you can use sale proceeds for that. What doesn't qualify? Prorated rents and security deposits. If you pay them out of the proceeds, it's taxable, so many people will bring in their own funds to pay those off. Anything that has to do with the mortgage is not an allowable cost of purchase. Do people roll those into the mortgage? Yes, they do, but their CPA would deal with that. So these are the types of things. Fixing up a property prior to the sale and trying to get reimbursed from your settlement statement is a taxable event. Doesn't qualify for the most part. So let's take a quick look at the exchange equation. I'm going to run through these pretty quickly because you are going to get a PDF that I'm going to send to Lauren after this program. I'll PDF the slides and send them to you so that you'll have them to support the notes that you had. So you'll have pictures to look at. All right, so someone sold a property for $900,000. They had debt of $300,000. If you've noticed in the equation I showed you, you didn't see anything about subtracting the mortgage, did you? No, it's a financing tool. It's part of that price that someone's agreeing to pay you $900,000 for your property. So in order to defer all the taxes, you've got to buy the $900,000 minus those $60,000 of closing costs, which brings you down to $840. So your new property needs to be $840 or greater. So in this example, you've got a net equity of $540,000. It's going to go into for the purchase. You'll take a new mortgage of $660,000. And they were buying a replacement property for 1.2 mil. So that would be a full exchange. All cash goes into the transaction. You make up any difference with a new mortgage. In a situation like this where the person's buying down in value, so they sold for $900,000, all these equations are the same. They decide they're going to keep $100,000 in cash because they're buying for $700,000, $440,000 goes in. Their mortgage is $260,000, so they've got $100,000 in mortgage boot, $100,000 in cash boot, $40,000 in mortgage boot. The term boot is any unreinvested value, and it's all about the numbers, folks. So it's all about the numbers. So in this case, they have mortgage boot of $40,000 and cash boot of $100,000. Okay, we only have 5 minutes, Lauren says, so I'm going to punch through this next slide because you can look that later. What is the role of the qualified intermediary? To have a consultation with the client. Really, we as QIs, as far as ethically, really should not be taking orders like pizza orders. We are not permitted to provide tax or legal advice, but we can provide the Treasury guidance about 1031, look for those red flag issues, and help clients construct questions to ask their CPA. So we are not able to guess or assume. So we need specific answers from CPA, tax advisor, and sometimes your attorney. But what we end up doing is we produce the documents to make it a 1031 exchange. We're on the title for a nanosecond. There's an assignment agreement, assigns our right to the title. So this is all the technical stuff behind the scenes. So exchange docs consist of the 1031 exchange agreement that announces the exchange, the assignment agreement that waives our rights to the deed, and we take the funds at closing, we send them out for the next purchase. We end up producing the exchange documents for the purchase side of the transaction. In a 1031 exchange, here's what the timeline looks like. Lauren, I might be taking just a couple minutes of the Q&A time, and I'll try to wrap up because I've got a couple of really important slides that we're going to go through. Sorry about this. Let me go back.
No, that's okay.
Okay, so date of sale. Let's just say someone's selling a property August 1st. So you're going to put August 1st in a little note on your timeline here. This is still a real estate transaction all. So anything you would normally do in a real estate transaction is still works. So when you've got a client that's going to sell a property, say they're going to sell September 1st, let me make it easy. So you've gone for the listing agreement, you're helping them get a buyer for their property, but you know they're going to do a 1031 exchange, or you know they're going to buy another property. Let's just say any transaction, right? And they're going to go buy another property. You can still be helping them go look for the property they want to purchase. They can even enter into a purchase and sale agreement on it and make a deposit. You just want to be sure you set the closing date up for the property that they want to buy for after the closing date of their sale. Bottom line, no need to tell the seller of the replacement property it's a 1031 exchange. All you're talking about is my client needs to be able to close their sale first to have the money to be able to buy their new property. And just like normal, they're going to either have a lender to bring in mortgage money or it's going to be a cash transaction. Doesn't make a difference, okay? You're just setting up the transaction so the sale closes, in this case, October 1st, and you're setting a purchase date for the closing for after October 1st. Keep in mind, anything that's going to hold the sale date up is going to usually be the result of something that's going on if the buyer has a lender. And it's not that there's anything wrong with that picture, it's just that that's what happens. Oh, they couldn't get, the fire inspector came, they want new smokes put in. Whatever that stuff is can hold up a closing, so make sure you put some wiggle room between the sale date closing and the purchase date closing. So let's look at this transaction. Before October 1st comes, they're getting their property listed, they're trying to find buyers, accept offers from suitable buyers. In the meantime, you've talked to them about what they want to buy, you're actually out looking for properties to buy, and however a transaction happens. But now October 1st comes, the taxpayer, the seller, exchanger, all names for the same person, lets the qualified intermediary know, lets me know, hey, I found a suitable offer for a buyer. I'm going to get the name of the attorney. I'm going to request transactional documents. It's from those and my interview with the taxpayer about the property they're selling that creates the file. From that information, the QI is drafting the documents for the 1031 exchange. They must be in place for the October 1st sale because that's what starts this timeline. The seller / exchanger signs the exchange documents, the timeline kicks in. They've got a 180-day timeline, which includes weekends and holidays, to actually close on the purchase of the replacement property or properties. The first 45 days is the identification period. Upon receipt of funds, asset preservation as the qualified intermediary provides not only their account summary to show that we received the funds, but also the identification notice. They have until midnight of the 45th day to fill out the notice, unless they buy all the property they want to buy and it's all done. Then maybe they don't need to submit one, but we'll talk about that as the transaction progresses. So, but if they haven't purchased what they plan to buy by midnight of the 45th day, if they want to continue the exchange, they're going to send in a notice with property or properties they plan to purchase. If day 45 comes and they simply cannot find anything to buy, don't send in the ID. Day 46, we can give them their money back and they'll pay their taxes on their the next time their taxes are due. But if they plan to go forward and they're going to close somewhere in this timeline, that ID must be filled out. So what does that look like? They have the choice of 3 different property rules. Again, the goal is to purchase equal or greater in value than the property they sold, and truthfully, it's the net sales price. The sales price net those allowable costs of sale is that target number. They can identify up to 3 properties of any value with the intention to buy 1, 2, or all 3 to meet that goal. However, if they decide they want to purchase identify more than 3 properties, they have a rule on the limit of the value, but not on the quantity. So basically, if someone's selling for $500,000, let's just say that's their contract price, okay? 2 times 5 is $1 million. They can identify 4 or more properties, but the total prices can't be more than $1 million, 2 times the 500. So on the identification notice, next to all the properties they identify of 4 or more, they're going to actually use the price of the property. If there's no purchase and sale contract at the time they need to identify, they'll use the listing price. If they have a contract on any of the properties, they'll use the purchase price of the contract, okay? So the 95% rule is like playing a game of chicken on Interstate 95, like way, way, way up north, okay? Because if you identify more than 4 properties and the values go over 2 times the sales price of what they sold, they have to be able to buy 95% of the properties. I'm not going to spend much time on that one, but I will tell you the 200% rule is really for when people are selling in a highly appreciated area and buying in a less or expensive area. So if you sell in Cambridge for $1 million, and you're going to go buy in Springfield, where I do deals all the time that are anywhere from like 185 to like 250. Maybe they're going to pick up a bunch of properties out that way. So maybe they're going to use the 200% rule. Identification is either in writing. You're going to describe the property if by a street address, street name, city, and state. But sometimes you'll see things that say 123 Main Street, like Boston, Mass, but it's formerly known as Dorchester, okay, something to that effect. Or it's 123 Main Street, formerly known as 456 Ellen Street. If that's, they may want to describe that. It doesn't, you don't have to, as long as there's a mailing address, that's fine, but it needs to be accurate. If there's a unit number because it's a condo, be sure that it shows up. We can take them, when we give the notice, people can sign them, like put the properties on there, sign them, date them, and scan them and email them back, or they can fax them back. All fine. Nothing we do is notarized or recorded. Here's a little look at the identification notice. One more thing I want to tell you. Suppose, Lauren, I'm picking on you again. Suppose Lauren's my exchanger. She sells a property for $500,000. But she says, Lynn, there's this really great, and I'm another exchanger. I'm just a friend, okay? And we decide there's this $1 million property we want to buy, and I've had an exchange for $500,000. Or she could be selling for $600, I could be selling for $400, okay? But we see $1 million property that we like, okay? I can either be investing with her, or I could be an exchanger. Let's just say I'm not exchanging, I'm just another person that wants to buy. So what Lauren would do on this $1 million property, she would identify 60% of this address. If I'm exchanging on my ID notice, I'm going to identify 40%, or I'm just going to be just another investor that's going to own 40% of that deed. Because she's only going to buy 60% of the property, she's got to write that on there, because you have to be able to buy substantially what you identify. So she would put her percentage. We'd have to go on the deed as tenants in common or co-owners or something. We could not form a business entity because tax ownership would stay the same, because we're going to assume that Lauren was an individual selling that property. Again, things to talk about, but I wanted you to notice why the percentage is on there. Same thing, which is the slide I'm racing to get to because it's so important. Split treatment transactions, what's that? I think it's the next slide up. Owner-occupied multis. So, or say I sell an investment property, but I want to live in the property I'm buying. It's an owner-occupied multi. Say I sell a property, an investment property for, gosh, I got to make something up. I'm going to make it easy, $750,000. I find a property that I want to buy, okay? And I want to live in a unit. Let's just say it's in $1 million building. All 4 units are the same size. So 3 of those units would be worth $750,000. I'm going to write 75% of that property address that I'm identifying because I'm going to live in one of those units. So that's what you would do here. Okay, multiple property exchanges, no rules up front on how many properties to sell, but realize the timeline is going to start at the date of the first one. Ideally, all 3 properties in this case, the person was selling 3, same taxpayer, could all go into the same folder if they all close by that 45th day. You're going to use the 180-day timeline for the first one. Real quick, let's just say only 1 property sells, the other 2 sell. Take a look at the timeline, say day 60 and 90 respectfully. It would be another file or 2, right? But you're still going to use the same 180 days of the closing of the sale of the first one to be able to use the funds from all the properties. You'd have multiple exchanges, same taxpayer buying the same property. Talk to me if it's the same person, but they have different taxpayer IDs. That's an offline, an out of webinar conversation, but that can work too. But always when you're trying to acquire the same property, you're going to go from the timeline to the date of the sale of the first one. Okay. I think that brings, I try to pack a lot into this hour. All right, this is when you're buying multiple replacement properties, just has to close by 180 day. I gave you more information you need. Okay, here's the slide I want. Primary residence. So if you're selling an owner-occupied multifamily property and you want to do a 1031 exchange, you're going to go by the 120 run rules for the exclusion for up to $250,000 in gain as a single owner. $500,000 married filing jointly, living in the same residence. That's primary. You had to have lived there, used it as a primary residence for 2 out of 5 years. CPAs will tell you it's really 24 months out of 60. So you need to know the dates that you need to cooperate by, okay? And then the other units in the building would be considered investment property if they were used as rental, okay? So here's a look at one. So let's just say $1 million sale, all units are the same size. Your principal residence one is valued at $250,000. You've got $750,000 less 3/4 of the allowable costs of sale, which is 3/4 of your real estate commission, 3/4 of your tax stamp and recording fee, 3/4 of the attorney fee, and the whole QI fee. Person can walk with their exclusion money, and then they have $750 net, the allowable cost of sale, to go buy another replacement property on their own. They can go buy a primary residence somewhere else. Realize if there's mortgage value attached to this, you can't attach the whole mortgage to the investment side. It's got to be divided where 3/4 of the value is part of the net sales price of the $750, say, and then 1/4 of it allotted to the primary residence side, because you can't put all the cash on the investment side and walk away with all the cash for the primary residence. I know that's a little technical, but I just wanted to talk to you about it. So as an agent, you need to talk to me if they're going to exchange. Let's have that conversation. I can't do the math, but I can tell you the math to get an idea of what they need to look for reinvestment, and then verify it with their CPA. So one of the last slides, if I can go back for a minute, this is going to talk about all the different sections for as far as when you're allocating it for Section 1031. But when you're talking about where 1031 and 121 actually can coexist together, 2004-51 of the tax code talks about converting a rental to a residence, converting a rental to a residence to a rental, and also split treatment on time. I'm working with an exchange now where someone lived in a property and then they converted it to a rental for a couple of years. They're still within the 24 months out of 60, but they sold for way, way, way more than their exclusion allows. They're able to take the exclusion on the first 500,000 and 1031 the remaining boot into investment property. It was done on time, not space, because it was a single family. So thank you, Lauren, for the time. That's what I wanted to pack in. I'm going to open up for questions. Here's due diligence on a QI. I'll let you look. It's a non-regulated industry, so you need to know who you're working with. Here's my contact information. Open for questions. We got about 6 or 7 minutes. Thank you.
That's okay. We can extend the time of it. That's totally fine.
Okay, so, just wanted to get it all out on the table for everybody, so fire away.
Yes, absolutely. We already have a bunch of questions. So first one is, can a single family income property be exchanged for a 50 homes development project?
First of all, how are you going to take title? If you're investing into the business entity that's developing, no, you have to have a deeded ownership interest under the tax ID number that you've been using to sell the property. So you'd have to go on with that business entity. You cannot buy into the business entity. Secondly, what's happening after the project's done? If the properties are going to be sold off upon completion, no, that's property held for sale. If they plan to hold them for rent and you're going to have your own tax ownership in your portion of the property, then I cautiously say yes until I hear more details.
Would selling a second home in Massachusetts to buy a second home in Florida qualify?
Second homes, how are you having too much fun? So my question would be, in the last 24 months, how much time did you personally use the property? How much rental time did you have? And then once I hear your answers, I'm going to say, okay, verify that your CPA says this is fine, or it may look to me based on your answers that it's fine. And so then into a qualifying vacation property. So for the next 24 months, are you using Vacation Home Guidance 2008-16? If your property qualifies on both sides, then yes, you can do a 1031 exchange and do that, because you can exchange. This is a federal tax code. You can exchange to any state in the country. But if you're telling me, no, we stayed down there 3 months, maybe you collected rent, reported it, maybe you collected it and put it in your pocket, and you're planning to do the same thing on the other side, big nope. But I would still send you to your CPA to talk about it.
Does it change qualifications if an investor occupies the property during rehab?
Well, are you rehabbing to rent it, or is it a multifamily or single family? If you're staying there because you're rehabbing it, your timeline for how long you held the property for investment purposes isn't going to start till you start renting it. So when you're talking about how long to hold a property, if you're the one doing developing it or rehabbing it, and you're going to sleep on the floor in a sleeping bag, that's fine, because your intent is to rent it out afterwards, but your timeline for holding it for productive use and trade or business is not going to start till it's done. So if it takes you 2 years to get that property ready to rent it out and for rental purposes, it's not start until then. It's going to start when it's finished.
Can the spouse that has died under his or her name buy another property under 1031 exchange and then add the other spouse's name to it after 1 year?
I'm sorry, a spouse that did what? Did you say a spouse that passed on?
Yeah, can the spouse that has the, oh, not dead, I'm sorry.
The spouse that has the deed.
I started getting confused too.
The wording.
Sorry, David, I screwed up
David,
your
that's my laugh for the day. Thank you, Lauren, for that. So far, you're the winner. So if there's a spouse on the deed, can they contribute? Can they add the spouse after a year's time? Well, yeah. So how long to hold? In 12 months' time, you can take a long-term capital gain. So we take a look at that as kind of like a guideline. Under a year of holding or something is kind of like a game of chicken on the highway. But after 12 months' time, you can take a long-term gain. So I wouldn't automatically go add them in conjunction with advice from your CPA. There probably would not be a problem to add your spouse, but just be sure that you're talking it over with them ahead of time and planning it, because does that mean you're gifting something to them? We're a non-community property state. That's where I put my toe up to the line, but I don't cross over. So now, if you've been having a married filing jointly return, there's some tax history there, but you've been filing separate returns, that's where you want to ask. But if it's married filing jointly, there shouldn't be a problem after 12 months, but do talk to your CPA. Don't just go have your attorney do it. Just because you can doesn't mean you should. You want to know if there's any other tax issues.
So what is considered your principal residence? For example, if you buy a 3-family, live in one unit, and then decide to rent out the unit you lived in and move into a new home, when is the 3-family no longer your principal residence?
Once you move out, but you've got up to that 24 months out of 60, and I have people timing it all the time, especially when they're working with the fact that their exclusion has already been exceeded. And I see this out a lot in some of the Metro West area at the Cape. So say, for example, you bought a property for $500,000, now you're selling it for $2 million, okay? You want to move out of it, whether it's a unit or it's a single family, doesn't make a difference. So you've moved out. You want to talk to your CPA. When do I need to put this property on the market and close the sale by, so I don't screw up my exemption, and set the closing date for well in advance of that? because of the fact that you want to be able to take the primary residence exclusion if you're married filing jointly for the first 500,000 or as a single filer at 250,000. So what'll happen is you'll take the exclusion at 500. So that'd be $1 million, and then the next $1 million less the allowable cost of sale, you're going to invest into investment real estate. Okay, so that's a split treatment. I have a whole article with all these different scenarios where 121 and 1031 coexist. So please email me for that. It's written right on there. Don't just take my words I said, take a look at it and go talk to your CPA. So yes, it can be done, but you need to know when you have to have the property closed by so you don't lose your exemption.
So Louise is trying to understand when the clock starts ticking on the 45 days. Does it begin once the seller signs a PNS or the day
No,
he or
date of sale. Date of sale. My example said they closed the sale October 1st. Date of sale. Date the benefits and burdens of ownership transfer. Where table states that they started the closing date.
In this split treatment example, could you then take the profits from the principal resident principal residence plus the 1031 for the other 3 units and put all of it into a primary residence?
No.
Okay.
I have 5 questions. That's the second one. I have no yes or no answers. We're down 2.
Yeah.
It's investment property for investment property, and it can be a partial investment provided the dollars match up. So.
Okay, I'm trying to see if there's any. I'm not sure if I understand, but are we getting a PDF with all the slides and contact infos for today's class? Yes, you are. I will be sending an email to all of you after this webinar with Lynne's information and some PDFs. So.
Yeah, there'll be a PDF for the slides. So go through, and then if I know everybody's going to want the 121, 1031 one. So, but any other ones you want, I will just email me and I'll send them out. I will send Lauren a PDF of the slides. I will tell you it's not going to be right away. I'm in the midst of a reverse exchange, which is really complicated. So it'll probably be this afternoon, Lauren, before I get it over to you.
That's okay. Yeah. Okay. But that looks like that's all the questions for today. As a reminder to everyone, this webinar has been recorded and will be available to view in the next few days on our website at marealtor.com. In the email that I'm sending you all, I will also send you the link to our website and a link to our YouTube page so you can easily view this later. Thank you so much, Lynne, for your presentation. It was awesome and everyone seemed very engaged. So thank you to everyone for joining today, and we hope to see you all next time.
Thank you, everybody. Enjoy your day. Happy selling. Again, I'm available for questions. I'm not billable by the hour. Any questions you have about 1031 ever, please call as you go along. I'm successful if you're successful. And so in the end of the day, the taxpayers who get to maintain and build their wealth and from working from you to help them do that are the winners in the end. So thank you very much.